Welcome to our channel, Stock Market Analyst. Today, we're diving into the basics of using price to earnings, P/E, ratios to spot good stock investments. By the end of this video, you'll have a clear understanding of what P/E ratios are, how to calculate them, and how to use them to make informed investment decisions. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is a P/E ratio? Let's start with the basics. The price to earnings, P/E, ratio is a valuation metric that compares a company's current share price to its earnings per share, EPS. It helps investors determine whether a stock is overvalued, undervalued, or fairly valued. The P/E ratio is calculated using the following formula. P/E ratio equals share price, earnings per share, EPS. For example, if a company's share price is $50 and its EPS is $5, the P/E ratio would be 10. How to calculate P/E ratios? Calculating the P/E ratio is simple. Here's a step-by-step guide. 1. Find the share price. Look up the current share price of the stock you want to analyze. You can find this information on financial websites or your brokerage platform. 2. Find the earnings per share, EPS. EPS is the company's net income divided by the number of outstanding shares. You can find EPS in the company's financial statements or on financial websites. 3. Calculate the P/E ratio. Divide the share price by the EPS to get the P/E ratio. For example, if the share price is $50 and the EPS is $5, the P/E ratio is 10. Types of P/E ratios. There are two main types of P/E ratios. 1. Trailing P/E ratio. This ratio uses the company's earnings from the past 12 months. It's calculated using historical EPS and is often used to assess the company's past performance. 2. Forward P/E ratio. This ratio uses the company's projected earnings for the next 12 months. It's calculated using estimated EPS and is often used to assess the company's future growth potential. How to use P/E ratios to spot good investments. Now that we know what P/E ratios are and how to calculate them, let's talk about how to use them to spot good stock investments. 1. Compare to industry averages. Compare the P/E ratio of the stock you're analyzing to the average P/E ratio of its industry. A lower P/E ratio compared to the industry average may indicate that the stock is undervalued, while a higher P/E ratio may indicate that the stock is overvalued. 2. Compare to historical P/E ratios. Compare the current P/E ratio to the company's historical P/E ratios. If the current P/E ratio is lower than the historical average, it may indicate that the stock is undervalued. 3. Consider growth potential. Look at the company's growth potential. A high P/E ratio may be justified if the company is expected to grow rapidly in the future. Conversely, a low P/E ratio may indicate limited growth potential. 4. Evaluate market conditions. Consider the overall market conditions. During bull markets, P/E ratios tend to be higher, while during bear markets, P/E ratios tend to be lower. Practical example. Let's look at a practical example. Here's a comparison of two companies, Company A and Company B. Company A. Share price is $100, EPS is $10, and the P/E ratio is 10. The industry average P/E ratio is 15. This suggests that Company A may be undervalued compared to its industry peers. Company B. Share price is $200, EPS is $8, and the P/E ratio is 25. The industry average P/E ratio is 20. This suggests that Company B may be overvalued compared to its industry peers. By comparing the P/E ratios to industry averages and considering the company's growth potential, you can make more informed investment decisions. Limitations of P/E ratios. While P/E ratios are a useful tool, they have some limitations. 1. Earnings manipulation. Companies can manipulate earnings through accounting practices, which can affect the accuracy of the P/E ratio. 2. Growth rates. P/E ratios do not account for differences in growth rates between companies. A high P/E ratio may be justified for a high growth company. 3. Market conditions. P/E ratios can be influenced by overall market conditions, making it important to consider other factors in your analysis. To sum up, the price-to-earnings (P/E) ratio is a valuable tool for spotting good stock investments. By comparing P/E ratios to industry averages, historical P/E ratios, and considering growth potential and market conditions, you can make more informed investment decisions. Remember to also consider the limitations of P/E ratios and use them in conjunction with other analysis tools. That's a wrap on our guide to using P/E ratios to spot good stock investments. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!